Welcome back to another video, guys. I'm Dave, and we're here this week talking about 5 stocks I'm buying for March of 2022. Now, if you're anything like me, your portfolio has been going on a bit of a roller coaster ride lately, up and down, more down than up. Unfortunately, we get some big bounce back days, but the direction has been sharply down, especially if you're into growth tech stocks like I am. So it's been a rough time, but that does mean that some companies go on sale or go for a lower price than you'd usually see. So I thought it'd be a good time to cover what I'd be buying in these current market conditions. So number one on the list is Tesla. Obviously, you know Tesla's going to be on here. I love it. It's one of my favorite companies. We've all made a lot of money off of it. And it's had a real pullback back over the last year or so. So if you look at the chart on Tesla here, from pretty much October until January, we have been in a downtrend. It's about here on the chart. Meanwhile, the company's continuing to ramp up production. They're forecasting an annual vehicle production increase of 50% per year, which is absolutely insane. Nobody does that. Nobody does even close to that. So manufacturing is so hard at scale. But they're doing it, at least so far. This year they have, the past year. And if they continue, then this might look like a steal. If we scroll down to the price to earnings, you can see that it has continued to fall. We used to be well above 400 a year or so ago. A year and a half ago, we were well above 400, and now we're way down at 117. And as we continue to ramp up and realize these economies of scale, I do expect the line to continue to go down. As we just completely crush this P to E down into what the big hedge funds like to see. And we're getting there a lot faster than most people thought possible. In terms of the RSI, is just kind of a indicator on how overbought or oversold a company may be. Obviously, it's not perfect. Nothing is. We are seeing it on a 3-year basis finally dipping into the oversold territory after, again, a monster run for the past couple of years. We're finally passing the the 50% line here, which is what I would like to see it at before I consider buying a company usually. And another indicator here, Williams is way down in the oversold territory. So this company just continues to be a beast. It's gotten caught up in these macro headwinds. It's gotten pulled down with a lot of the big stocks that are not making money, not making profits. Meanwhile, Tesla is making profits. They're making more and more every year. The P/E is still a little high compared to some companies, but for a company that's growing so fast, and as they grow faster, they realize more and more economies of scale, which actually improves their margins even more. To me, this is a buy here. Below 800, I think you won't regret it. Some more charts. We can see year-over-year revenue growth here, 64.9, almost 65% revenue growth year over year. That's amazing, especially when you're talking about a company that's manufacturing cars, not just software revenue. To grow over 50% is absolutely amazing. You can see sort of the trend line is amazingly up and to the right. So the growth is really multiplying, and it's even going faster. It's starting to pick up speed. Now, one thing I would like to see is this energy segment right here. It's not growing very fast. In fact, it shrunk quite a bit as they put all their efforts into ramping the Model 3, the Model Y, which are their big bet the company type products. Services, I know it's small, so it's hard to tell. It actually is starting to turn positive, which is nice. So as people need to service their Teslas, take them into dealerships or those mobile repairs, they're starting to get recurring revenue off of that. But obviously, the big factor here is in blue. Auto revenue, and that's going to continue to grow, and that's not even getting into the software revenue, full self-driving, which they're charging currently, I believe, $12,000 to $15,000 for, which is a massive amount of money. So every sale is huge, and yeah, just great growth, and I'd absolutely buy here. Okay, number 2 is Corsair Gaming's, and yes, it is a buy here, and I am a buyer at these levels, but I'm also giving it a little asterisk, and that's because it's kind of on probation for me. It's supposed to be a growth company. What they do is they sell a lot of computer gear for gamers or streamers, content creators, which is an extremely fast-growing area. Things like this webcam I'm talking to you on is made by Elgato, which is a company they recently purchased. It's more of a premium brand. They also make high-end keyboards, mice, speakers, microphones, and just all sorts of computer equipment. Now, gaming streaming is absolutely exploding these past few years with the pandemic. Everyone's staying inside, and it's not just gaming either. We've gotten to see a lot of interesting uses for this technology, things like DJing over Twitch, for instance, where they still need all this kind of hardware. One thing I'm not crazy about is I do tend to like having the option to have recurring software revenue on my companies. So this is strictly just one and done. You buy your piece of equipment from Corsair, and then that's it. Whereas, a company like Apple, they sell you their phone, and they're still going to make money off of you when you buy anything on the App Store, when you use any of their services, when they've pulled you into their ecosystem. So Corsair is a good growth company, at least it has been in the past. It's really struggled over the past year or so. This GPU shortage has really hit them hard in terms of their graphics cards and things of that nature. So the company is pretty much at the all-time lows here now. We're below 20. We're down at 18, which is pretty much where it listed at. So if you buy it now, there's no one who has ever bought it for cheaper than you on the public markets, which is kind of nice. Price to earnings ratio is down in the 16s now, which is very reasonable. When you talk about growth stocks, you're usually thinking of, potentially up in the hundreds. So that's kind of a multiple you would assign to a more mature company that's not growing so fast. And that's partly because they have been hit in the past year or two, as we'll see. They are showing extremely oversold on the RSI indicator and on the Williams indicator as well. So those indicators, of course not perfect, are showing that they're on the oversold end of things. If we continue on here, now this is the big reason why they've had such a horrible time right here. The revenue growth year over year is actually down, which means they made less money this past year compared to the previous year. We need to see that change. So that's why I'm saying this stock is kind of on probation for me. If the growth can rebound and continue, and this is just a temporary headwind regarding GPU shortages, which anyone in tech knows that GPUs are impossible to get these days. If it is temporary and the growth story continues, then buying it down at these levels is going to look like a huge bargain. But I do have to see that growth, because I'm not buying in this for some kind of a stable company. So here's the revenue and operating income. We can see they did have a pretty good growth in their revenue for a few years. And that's what you kind of want to see in a new IPO with a growing company. That was kind of the whole story. But we've obviously hit a bit of a downturn here lately. Now, this has been mostly attributed to GPU shortages and things of that nature. I don't think the demand is going anywhere. More and more people are streaming, more and more people are gaming, more and more people are creating content on YouTube. It's easier than ever, and more and more people want to do it working from home. Even just teleconferencing, working from home. You might want some higher end equipment, sound better in your meetings and presentations, like things like that. I could definitely see that being a growth area for them in the future. They also did buy a premium brand called Elgato, which I think was a smart purchase. But we do need to see this growth continue. Now, it has started to rebound a bit in the last quarter. And if this continues in this direction for the next couple of years, and this sort of downtrend here was just a little blip, I think buying at these levels will look like a huge bargain in a few years. But if we continue to see a few more bad quarters, I'm going to have to watch this one really closely and decide what to do with it. So we'll listen to all those earnings calls in the upcoming quarters, and it's a tentative buy for now, but we have to watch it very closely and make sure that they can return to the growth story that we're buying in on. Number 3 is Coinbase. Now, they IPO'd not that long ago as well. It's a bit of a trend in these companies. A lot of the recent IPOs have really got hit hard in the recent stock downturn. They opened way up at $350 a share, and we're now down to about $150. So dropped about 50% in the last year and a half. It's a big drop. RSI once again is showing down at about 34, so it's oversold. Same with the Williams, even more extreme. If you're buying it today, no one on the public markets has bought it for a cheaper price than you, unless maybe in the past few days in volatility. But overall, everyone in the past year and a half has been buying it for more expensive than you are today. And if we look at their monthly transacting users, we still have a good trend here up and to the right. There's always a bit of bumps in the road, but that is a pretty solid line of growth. So I'm quite happy with that. Going to hit $12 million soon. Sorry, 12 million users, that is soon. And in terms of year over year revenue growth, we have 327%. That's absolutely insane. Like, that level of growth is unprecedented. So they can sustain anywhere near that, even 80% is great, but 327 is absolutely outstanding. So it's a very interesting stock, growing extremely fast. Of course, crypto is a controversial space. I personally don't think it's going anywhere. It's almost gotten too big to fail at this point. There's so much big money in it now, not just retail investors, but also funds. People using it as a hedge for the markets, kind of like gold. Digital gold is what people call Bitcoin. I find Ethereum a bit more interesting. But there's just so many different cryptocurrencies out there now. The whole ecosystem is growing, and Coinbase is there to take advantage of it as your broker. Again, you can see the sharp up and to the right trend in terms of revenue. The operating income is looking pretty good, so they are making money at this point. And that's one I would highly consider buying today. You have to believe in the crypto space if you're going to buy them, but I think they're pretty cheap, and if they can show that kind of growth in the future, things are looking good for the company. Now, number 4 is a bit more of a safe play in these crazy times. Sometimes I just like to, have a safe, solid tech stock that's growing. So this is Google. They finally dropped back below 50 on the RSI. They are now at 44. For the past, call it 6 months or less, they've been on a bit of a downtrend, but the whole market has really. S&P, NASDAQ especially. Price to earnings ratio is 23. Now you can see I should have been highlighting these charts a bit more, but in terms of historical price to earnings ratio, you'd have to go all the way back to about March of 2020 to get to levels that were around this level. So it's got, in terms of a multiple basis, it's gotten quite cheap. It's pretty rare for it to hit these levels. You've got a few spots here, maybe like once every few years, but not very common at all, really. So if it dips to these levels, P to E of below 25, it seems like it's usually a pretty safe bet. I mean, zoom out on Google. Anytime you hold it over the long run, you can never go wrong. So if you're at all nervous in these markets, seems like a safe place to stash your money and get some good returns. We look at our revenue growth rate, 32% year over year. So for a company as massive as Google, usually these are mature companies, not growing at a very fast rate. They kind of sustain their business, maybe like 10, 15%, something like that. Google and some of these other big cap tech, mega cap tech, still growing at a really great rate. So if I get, 33% year over year growth going forward, absolutely I'll pay a 23 multiple on that. No problems there, especially when the margins are so high. They're sitting on a massive cash bank. They're doing a lot of interesting things and growing exponentially. As we can see, the chart, pretty steady. Nothing really to worry about here. We're making money. We have gross profits. We have operating income, and the revenue is pretty steady up and to the right. So all things you like to see in a mature company. Number 5, Wynn Resorts. Now, this is an interesting one. It's a little different than all the others. It's not really in the tech space at all. It's dropped a lot recently for a slightly different reason. That's because China has had a new surge in COVID cases, and they're really cracking down on it. So one of Wynn's biggest casinos is located in China, and there's a lot of worries about shutdowns there. But of course, that would be a temporary thing. It wouldn't continue forever. China's been very aggressive on shutting down any cases of COVID. And when that passes, I'm sure they would get back up and running again. They do also have other casinos running in Vegas and other locations. So they're not solely reliant on the Macau location, but it is one of their biggest ones. And if we go down to their chart, you can see here, we're getting close to the levels of like peak fear during the pandemic. So they were up at almost 160 before the pandemic hit. And then nobody knew what was going to happen when COVID hit and how bad these shutdowns would be, how long they would go for, if companies would go out of business, what kind of aid these companies would get from the government, if any, what kind of loans they would need to take, so much fear and uncertainty in the markets. And during those crazy times, Wynn dropped to around 60, maybe just below a few times, but not much below. We did make it back all the way up to 120. And when I think about Wynn, anytime you buy it under $100, I think you're going to do okay over the long run. We're now way down back at 69. So we're almost at the peak fear level, really, from when the pandemic first hit. And if you ask me, we're nowhere close to that anymore. The lockdowns are ending. Sure, there's a flare up in China. I'm sure they'll take care of that. Maybe it'll last a month or two before they get things under control. But the way they lock things down there, I'm sure they will get it under control. People don't have quite as much choice in the matter. And yeah, so if you can have a year ago win trading above $120 a share during the pandemic, and that was back when we had Delta strain rampant, all these things were still issues. If it's at $120 a share there, then I think we're getting it almost half that at the current price. So to me, I think you can make money on this one. I would have a price target on it of about $100 a share. And then I would get out just because it's not the kind of company I like to hold forever. I prefer tech and things of that nature, but when I see it this cheap, I just think it's a buy. We're also, again, pretty oversold on the RSI. Price to earnings ratio is, again, pretty much historically low. I shouldn't say historically low, because they've had some issues with COVID, so they dipped into negative cash flow, so the price to earnings was non-existent. But we're looking at the trend of the chart. We're down here. If you're looking for cheap times to buy it, you've had maybe a couple opportunities like this. This is like basically, peak fear of the pandemic, and just one or two times it's dipped below there, really. So seems like a bargain if you ask me. If you buy it, I think in 2 years you're not going to be unhappy with the results. And we look at the revenue growth year over year. Now, this is a bit of an outlier, of course, because of the pandemic. So you can't take a lot of stock in that, because a little while ago they were shut down. So 53% is great. I don't expect that going forward, but it is there to see they're at least rebounding a little bit. Now, they have dipped into negative operating income, as I said recently. So you do want to see that change, but at least the revenue has been coming back slowly since Q1 of 2020. We're starting to get a trend line there, which is nice to see. And this is a big one, kind of to show you what kind of money they could be making in normal times. So 2018, before the pandemic, we're looking at $6.7 billion in revenue, which is a sizable company. Now we're almost half that today. This is where we are today. So if we even return to 2018 levels, not even thinking about any future growth that they may be going for here, simply returning to what we had previously before the pandemic would, I think, drive the stock to at least $100 a share, if not more. And I would say we should be able to get there within a year or two for sure. I don't see any reason why we wouldn't be able to make it. So that is why Win is number 5 on my to buy list. But we have a bonus stock here, because why not, right? Number 6 is Shopify. Another really beaten down one during the recent downturn, where these high multiple growth stocks have been absolutely hammered. It's been pretty depressing. I was actually already a shareholder on Shopify, as well as some of these other ones, but holding a stock and watching it go from above 1,500 to 500, super painful. So I was sitting at a big gain. Things were going great, and now it's dropped by, more than half. It's dropped by maybe 60%, 70%. So that's obviously very painful to sit through. But what you do, if you still believe in these companies at these times, is you dollar cost average and buy it when it goes on sale. The RSI is once again dropped into oversold territory on this. Price to earnings ratio, this is incorrect. I was highlighting a different time, but you can see it's the lowest it's been in quite a while, since back in 2020. And their growth rate is still phenomenal. The growth story is still intact. This isn't like Corsair, where I'm a little concerned about the sustainable growth. The growth story is still intact here for Shopify. So if you're trading, and by the way, this is the real P/E ratio listed on Yahoo Finance today, $24 a share. So $24 a share, you would expect a company to be growing, maybe like 15, 20% revenues every year, something like that, which is like what you would think of for a more mature company. But if we scroll down, year over year revenue growth is 41%. So they're still growing at a tremendous rate. Very impressive growth. I don't see why it can't continue. I love the space they're in because I love software revenue and recurring revenue. When they sign up these merchants, they get recurring revenue from them. And it's becoming a big business. It's no longer a small startup. So to me, the company's pretty de-risked at this point. We're looking at revenue growth, profit, and operating income. As we can see from the operating income, we're starting to eke out some gains here. That's the red lines in the chart. So really, there's no risk in my mind of this company ever going out of business. Even if the growth slows, like they're almost already trading at a pretty reasonable multiple for a company like that. But I don't think the growth will slow. I think it will continue. I mean, we can see from the top line here, straight up and to the right, it's pretty clear. And usually what happens is if you're worried about this operating income being low, the expenses do not scale up as fast as the revenue and the profits. So eventually, once you hit scale and get bigger and bigger, your actual operating income numbers start to explode because a lot of the costs are fixed, but you're bringing in more and more customers, more and more merchants. So that's when you really get to see the cash cow the company can be. And we're getting there soon. I'd like to see profitability. I don't think online shops is going anywhere anytime soon. So Shopify is the bonus number 6, and that is our stocks to buy for March 2022. Obviously, I share these to give you ideas of companies you might want to look into, but please do your own research, do your own due diligence. Every single investor is different. We all have different goals, different appetite for risk. Don't just blindly copy anyone online, even me, perhaps especially me. But those are the 5 I'm interested in, 6 with the bonus stock, and I will see you next time. Thanks. Bye.